The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A rebound rally as Anthropic tries to play nice. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Christina Aquino. We're kicking you off to the closing bell here in the U.S. Caution over inflation. That is the message from Federal Reserve speakers that we heard from today. And that is, again, calling into question how much more can the Federal Reserve cut rates this year? That is, of course, affecting two-year yields today. They are up about 2 basis points or less than 2 basis points. Treasury's down at the moment. Let's also take a look at dollar yen today. We did hear from Prime Minister Take Sakaki saying that rate hikes in Japan potentially casting doubt over that prospect. And again, the yen weakening as a result of that. The yen, of course, weakening by the most among G10 currencies today. Also taking a look at the NASDAQ, a bit of a recovery for tech stocks today. That index up more than 1% after taking the back foot yesterday. It's a bit of a turnaround Tuesday for tech here. And finally, AMD, a big winner today. That is because we did get the news from Meta saying that they will be investing billions of dollars buying chips and the company stock, and that has boosted the stock by more than 9% today. Romaine.
Yeah, a lot of moving parts here today, but it's kind of interesting. We talk about the relief rally that is afoot, but the more interesting story is who's not participating. Take a look at defense stocks, take a look at freight stocks, consumer durables, and healthcare is all weak in the knees on this Tuesday afternoon. Healthcare particularly under pressure ahead of the president's State of the Union speech tonight that is expected to focus on affordability, with insurers likely in the crosshairs. United Health down a second straight day. Humana and Elevance, they're down a third. As for the rebound rally that we're seeing today in software, well, you can thank that hour-long live stream by Anthropic this morning that seemed to suggest the AI company can be more of a collaborator than just a disruptor. Its never-ending rollout of AI tools now being framed as able to connect rather than supplant some of the services provided by names like Salesforce, Intuit, DocuSign, and others. Salesforce, which plunged 4% yesterday, rallying as much as 6% today, while Workday, well, it's still got some work to do, clawing back just 1 point of the 6 percentage point drop from Monday. And that's notable because software stocks as a whole, they still remain mired in a bear market deep. And the real flow of money, it's still going into what Goldman strategists call halo stocks, or those with heavy assets and low obsolescence. Think networks, infrastructure, engineering. That includes chip lithography company ASML, which is up 40% to start the year. Fiber optics company Corning, that's rallied 70%. And water handling business, Texas Pacific Land, up more than 80%.
I think the importance is going to be nimble, to be focused on companies that ideally have resilient business models, that have proven ability to generate cash flow into the future and can adapt with the time. So this type of volatility and back and forth that we're seeing in markets is a bit of a byproduct of, research reports and focusing on what's happening with the AR trade. It's a kind of thing we'll probably continue to see in the weeks and months to come.
It is the talk of the town as we kick you off to the close here on this Tuesday afternoon. Mo Haghbin joins us here in Studio 2, head of strategic ETFs over at ProShares. Mo, great to have you here.
Good to see you.
Let's start off on the AI side of this, the AI trade, the AI infrastructure trade, and what exactly is happening right now? Are we seeing sort of people, I guess, turn their backs on it, or is this simply this idea of it broadening out to something more than just kind of what brought us here over the last 3 years?
Yeah, great question. I think what we're seeing is investors being a bit more discerning and looking through all of that kind of company cohort and thinking about who the winners and losers are going to be. And I think, the question is really that CapEx spending. What is the return on investment, right? If there's a terminal value here in terms of where these companies can make these investments and get that return, I think that will be rewarded. But not every company in that cohort is set up that way.
We'd be remiss in not pointing out that in about 24 hours time, 25 hours or so, we're going to get earnings out of NVIDIA. Of course, probably the AI darling of all AI darlings. Is that still something that investors are attracted to, or has the valuation and, more importantly, I guess, their moat that they've enjoyed now for the last few years, is that starting to show cracks as well?
Well, I think you're always going to have investor attention on one of the largest companies in the broad-based indices. And I think what's really interesting there, Romaine, is not just the event of the earnings, but really how does that translate into the broader market indices and the performance of the indices? As you recall, in 2025, a very significant portion of the return of the overall market was driven by a handful of stocks, including NVIDIA. So we have to pay attention to these events because they have such implications across the broader capital markets.
Now, I also want to turn our attention to what we heard from Federal Reserve speakers today. It seems like the consensus is there's a lot more emphasis on the inflation mandate part of the Fed. And we did also get a trio of Fed surveys really weaker across the board there. So how does that square up in terms of Fed outlook? And in turn, how much can that support the equity rally that we have seen generally being dependent on more rate cuts in the future?
Sure. I think the consensus is still rate cuts in the near term. Maybe a little bit of that is priced out in the back half of the year, but there's no doubt the short end needs to come down and the yield curve needs to be a bit more normal and a little bit steeper. So I think that's still accommodative for risk assets, accommodative for equities, but I think we need to be careful. The mandate is a dual mandate and there is more balance in that, right? So the Fed isn't just looking at inflation, it's also looking at employment data, which has been a little bit softer. Even though we saw a little bit of a surprise in January, I'd be cautious to look at the revisions and really understand whether or not that's telling the full story.
Yeah, and of course, for a lot of investors, the ultimate fear is a stagflationary environment, right? And do you think that we are potentially heading toward that sort of environment, or are some of those fears around that overblown at this point?
Yeah, it's a good question. Look, there's definitely arguments on both sides. I don't see that. I think there's going to be a healthy balance. We obviously have sticky services inflation still. Goods is under control. But look, shelter costs are still very high, and we need to see improvement there. At the same time, a lot of this AI theme is leading people to think, well, look, things are just going to be more efficient. Things are just going to get more productive. I think there's a healthy balance there. And I think your comments earlier around, does AI become something that replaces productivity or enhances productivity? I tend to lean in the latter camp.
I am curious that when you look across markets, equity markets, and particularly flows into ETFs, let's just kind of pick your brain and your expertise here. What is that showing? Is that showing sort of a defensive posture? I understand people are still buying, but it does seem like they're going for quality in quotation marks, value in quotation marks. Is that what you're saying?
Yeah, look, it has been a record start to the year, right? If you look at flows across the broad ETF landscape, it's one of the fastest starts ever. But I think to your point, Romain, you have to look at where things are headed in terms of the segments of the market. We are starting to see that rotation play out in flows. So smaller and mid-capitalization stocks, international, which last year also was a pretty big outperforming segment of the market. To me, it's becoming a bit more tactical because the dispersion at the sector level is increasing. So clients are becoming a bit more nimble and thinking about how to position a portfolio and moving away from just the vanilla broad-based indices. And that's really what we're seeing in flows.
All right, Mo, always great to have you. Great insights as always. Mo Haghbin is head of strategic ETFs over at ProShares, kicking us off to the close here on this Tuesday afternoon. We are going to continue to focus in on that turnaround in tech stocks. We're going to catch up with Brent Thill, who just yesterday downgraded several key names in the software space, including Workday, which reports after the bell. Stick with us. This is Bloomberg. All right, software stocks back in the driver's seat for the day, but still mire deep in a bear market, particularly application software stocks. And we're going to get some earnings out of several key names in that space, including Workday after the bell tonight, Salesforce tomorrow, Snowflake, Intuit, and a few others later in the week. Just yesterday, a couple of those names were downgraded by our next guest. Brent Thill joins us right now, tech sector leader of software and internet research over at Jefferies. All right, Brent, first I want to start with the downside here. You saw DocuSign, Monday, Freshworks, and Workday were downgraded yesterday by you. I am curious as to what your primary thesis is for that downgrade.
Hey, Romain, we started the year with an underweight on software and overweight on infrastructure, which is the hyperscalers. It doesn't matter where AI lives. It's going to live on Microsoft, Amazon, Google, and an underweight on applications. In the application space where we made the changes yesterday, we just prioritized where we had more conviction. I like Intuit, Procore, Salesforce, a handful of names in that space better than certain names. So we're not necessarily effectively trying to call a bottom here. We're just effectively saying, they're just in the downdraft, where do you go? And we focused on names that we think have a more durable moat than some of the names we discussed. For Workday, we think this is, again, a story that's not going to get AI'd, but you've had a sudden change in the CEO. The head of sales was forced out. You've had a number of other executive management changes, and investors are still clinging on to a 13 to 14% midterm growth, given AI, given all the changes, given new heads of sales. I mean, we've seen this movie before.
Yeah.
When you change a head of sales out, everything else ripples. So what's the impact going to be to Workday's outlook on this change? And again, remember, they're bringing the co-founder back, Aneel Bhusri, who is a phenomenal long-term leader in the software industry. But I don't think anyone believes he's the long-term guy, given he stepped away just a few years ago to give it to the outgoing CEO just left. So again, I think higher conviction in other names. We've had an underweight on software because of AI. So I wouldn't say it's a big change for us.
And we should point out, yes, there are some idiosyncratic issues with Workday as well. I do want to go get your reaction, though, to some of the news that we learned about today coming off that live stream that Anthropic had, which seemed to suggest a little bit more of a collaborative approach with some of its AI tools, and whether that has the potential to change your broader thesis on software overall in terms of that underweight.
Yeah, this is a mountain climb, and think about it as 10 passes we're going through. We just went through the first pass, so we got 9 more to go in terms of the walls of worry, if you will, for software. So the first pass we went through is OpenAI and Anthropic going to kill software? The answer is no. They're going to collaborate. It is not a magic button and the whole software stack gets recreated. It's not happening. Enterprises will never do that. And so I think it's a better approach for them to go in partnership with Intuit, GoDaddy, the rest of the industry. So we think that that's a good thing that they're coming out. We've said this, OpenAI and Anthropic need to go public so that software investors actually understand where they're going, right? No one wants to get stuck on the Hillary step with these companies right in front of them, and the climbing analogy. So right now, I think this is a good update in terms of what Anthropic said. I don't think investors really truly believe them. There's this belief that they are trying to literally take over planet Earth of software and suck all the data out of these systems of record, and then the Workday Salesforces become zombie systems. I don't think that happens overnight, but I think it's a good move. And again, I have conviction that these companies aren't going to replicate, because look at Google. When Google started Google Cloud, they had great tech, but they didn't have like the most amazing go-to-market people, right? And so if you look at Anthropic, right, they're great technologists, but they need, Google needed Thomas Kurian, who had 20, 30 years of experience to rebuild. Again, I'm not here to judge the Anthropic team, but I don't think the quality of the enterprise knowledge is quite there yet.
Yeah, well, Brent, I got to ask you about the other piece of big news that we got today, which is, of course, Meta's investment in AMD. Very interesting that they have a deal to not only buy chips, but also an option to buy shares in AMD. What do you make of that move? Is that a bit of a new normal that we're seeing in the tech deal space?
Yeah, I'll scratch your back, the other vendor will scratch my back. That's kind of what we're seeing, with NVIDIA, CoreWeave. We're seeing it across the industry. And I think it worries a lot of investors. I mean, Bill Gurley was on another show this morning, the famous venture capitalist, and he said, I put in all these things in ChatGPT to see what was the outcome, and it said Enron. It said WorldCom. And so, you think about, like, are all these things amazing long-term? No. Is there going to be some counting issues? Are there going to be other issues? I mean, I think Bill raised some really good points. So I think we're all a little bit on edge. Like, are they all getting too cozy with each other? And, at this point, obviously, they're incredible technology companies. They need to go to market. It's great to see the industry bonding together. I don't think this was like when Tom Siebel was putting these barter transactions in his filings and, like things fell apart because they were stuffing the channel. I don't see that. I lived through that. But I think it's got everyone a little bit on edge. Are we going to overbuild? What are we going to do with this excess capacity? Is there a bubble? Sam Altman has said this. We're not really going to know, but we probably will overbuild in 2 to 3 years. It's going to take a few years to figure that out.
All right, Brent, got to leave it there. Always appreciate it. Brent Thill, tech sector leader of software and internet research over at Jefferies. And a reminder, Workday reports after the bell, that conference call at 4:30 p.m. New York time. When we come back, we're going to check in on the state of retail, specifically with Saks Fifth Avenue. We caught up with the CEO of Saks Global. You want to hear what he has to say about the company's bankruptcy and restructuring. That's coming up next here on The Close. This is Bloomberg. It's been a tough few months for luxury retail. The parent company of Saks Fifth Avenue, Neiman Marcus, and Bergdorf Goodman filing for bankruptcy last month, and just this week announcing the further closure of several stores. I had a chance to catch up with the CEO of Saks Global, Geoffroy van Raemdonck, to talk about not only the company's bankruptcy proceedings, but what the path is to revenue growth and, more importantly, to profitability. Take a listen.
The relationships have been damaged. And when I joined a month ago, a little bit more than a month ago, the goal is to reestablish those. And so I'm pleased to say that today we have 380 brands that are shipping, and that accounts for 75% of the seasonal inventory that we want to have. So they've committed $1.2 billion of inventory, and that is 75% of what we expect between February and the end of April of fiscal Q1. And then all the brands that operate in concession where it's their inventory, those are fully functioning and fully staffed, with brands like Chanel having the new collection of their designer fully complete in our stores.
What are the payment terms looking like right now? Are they under the traditional model, 90 days or longer, or are you still up against a 30-day repayment?
So we are, the original element payment terms is 90 days, but it differs by type of brands. And so there is some difference there. But the brands that are shipping on the terms that were existing pre-petition, whatever the terms were for that specific brand.
With regards to the level of inventory that you have, how does it compare now relative to where you were, I don't know, maybe 2 or 3 years ago before we started to see a decline?
So the level of inventory today is lower because there was a pause in receiving goods, and specifically the seasonal goods, and that pause happened in December and in January. With that said, if I look at this month, which is our first month of the fiscal year, we are flat this month on inventory receipts compared to the prior year. And if I look at last week, we were up 29% to the prior year. And so what you can see is that the brands have really moved back to ship, and they do it because we have ample liquidity with the new funding that we access of $1.7 billion of committed capital. And that gives me the confidence that the inventory is going to continue to increase and ultimately will catch up on the inventory position.
Where do we stand right now with a return to more normalized levels with regards to foot traffic?
So the foot traffic is slightly down, but not as down as the sales. What we're seeing is a conversion is lower because the consumers have not necessarily found the products that they wanted. That was very true in January. When we look at the performance in February, it is much better than it was in January, and it's improving week after week. Now, if you look at our best customers, and 2% of our customers do about 40% of our revenue, those customers continue to spend in average per transaction more than the prior year, and those basically stayed with us the prior year. Our bestseller sales associate who cater to those customers were up in 25 compared to 24. So there is a segment of customers that is very loyal and who's actually not impacted by the inventory reduction. And then there has been a slowdown in the performance, but it's really all linked to the availability of inventory.
There's been third-party data that has shown that a lot of the customers that would have walked into a Neiman Marcus or a Bergdorf or a Saks ended up going either into stores like Bloomingdale's or maybe even directly into some of the branded stores itself. Are you concerned that maybe you've lost some of those customers to your competitors for good?
We believe that the consumer have access with us to brands that are not represented everywhere, and that our sales associate have a unique skill set of outfitting and styling for what's right for the consumer. So I believe that those relationships will continue to exist. But there is a need for us to get back the inventory and to really leverage the access to funding we have to continue to do what we do best, which is serve the customers. Now, when I look at our sales associates, they continue to be performing well. And when I look at the brands, they continue to invest in special activation, special collections with us. And so the spring season is one that I believe will see a change in tide in this environment.
Have you been able to retain your sales associates? There's been reports that Bloomingdale's and other stores have tried to poach some of your employees.
There's been a couple of associates that have been poached, and some of them were quite visible. When we look at the number of sales associates, and we have 1,500 sales associates who sell more than $1 million, and collectively they almost achieve $3 billion of revenue, we've lost a fraction of those, and the vast majority, we've retained more than 95% of those. So in terms of retaining the top talent, we feel confident. And I think what I take very seriously is to make sure that we support those teams. And the best support we can have is to provide them the inventory to sell to their clients and delight their clients.
As you work through the restructuring of this company, what does the footprint end up looking like? You've already shut down most of the off-price stores. There was an announcement of a reduction of about 10% of your full-price stores. How much further do you go in this? More store closures?
The goal is to create a Saks Global that is profitable and sustainable. And so the first thing we've done is refocus on retail. There were a lot of activities that were real estate driven and that didn't add value or were not profitable. We've decided to focus on the full price selling and luxury. And so we are winding down the Saks Off Fifth chain and only keep a handful of stores that are going to be there for the liquidation of the inventory that we didn't sell. But then on the full price selling, we are looking at our stores and really assessing which stores are profitable or have the potential to remain profitable for the future. And what we found is that we had presence in markets that were not commanding the size of the business that we want to do. And then we are continuing. So we made the decision to close 9 stores, and we continue to assess the footprint and look at markets where both brands exist.
Is there any discussion about a potential stake sale in Bergdorf Goodman?
There's no discussion today about a stake sale of Bergdorf Goodman.
Would you consider a stake sale of the operating business there?
I think we'll always assess our footprint, we'll always assess our assets and make judicious decisions that are best for the company and for the shareholders. But that's going to be something we'll always do. It's not a topic of today.
Geoffroy and Raemdonck, the CEO over at Saks Global. Christine, I don't know if you've been in a Saks lately or in the markets. Bergdorf is right down the street there.
Yeah, it's right down there. Yeah. I hear, though, that there is a lot up for grabs there. And inventory is flying fast off the shelves.
Yeah. All right. Well, they got some challenges ahead of them. When we come back, though, we're going to focus in on healthcare. Some challenges there as well, particularly with some policy changes out of Washington. We're going to catch up with the president of Health Solutions over at Elevance Health. Elevance, of course, that's the company formerly known as Anthem. She joins us after the break, right here on The Close, right here on Bloomberg. 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Christina Aquino.
All right, well, there's a big speech later tonight by the President of the United States. The State of the Union address and affordability, of course, going to be top of mind. Elevance Health, that's the insurance giant formerly known as Anthem. It's actually finding itself at the center of the health affordability conversation ahead of that speech. The company among more than 36 employers, insurers, and patient advocates pushing the administration to intervene in some of the fraud arbitration process tied to sort of quote-unquote surprise medical bills. Joining us right now is Catherine Gaffigan. She's president of Health Solutions over at Elevance Health. Catherine, great to have you here on the program. I first want to start off with the general idea of health affordability. And I know that's kind of a double-edged sword for you. At one point, of course, you have to run a business and, of course, make profits. On the other hand, you have a lot of pressure coming from the administration and from quite a few others looking to find ways to keep a lid on health care costs. Square that circle for us. Can we do both?
Thanks, Romaine. Really appreciate being here. And we have to do both, to be quite honest, for the health of the country, both from a financial perspective as well as an actual health perspective. We have opportunity, as an industry to address a variety of factors together. When I think about what are the things that are causing healthcare costs to rise today, I think about utilization. So as an example, our population is aging. So we have an older population. We tend to have folks with more chronic diseases, and so utilization is up. Additionally, some of our cost inputs are up, whether it's hospital cost or it's pharmaceutical costs, the cost of health insurance itself. And then we have regulatory changes. We have technology advances. And finally, there's fraud, waste, and abuse. And I think, we have to attack all aspects of this. Some are easier to attack than others. There's no silver bullet. But we're really, committed to delivering affordability for our clients and just as much for the rest of the nation.
I am curious that with regards to those elevated costs, and I know it's a confluence of a variety of costs that go into that, but is there any one thing that you think can be that low-hanging fruit that overall, collectively, we can address that would actually maybe make this a little bit more tenable?
Yeah, that's a great question. Fraud, waste, and abuse is definitely a place to be focused. And one of the areas that we are talking about, which you kind of mentioned at the beginning of this, is around the No Surprises Act and the independent dispute resolution process that is a part of the No Surprises Act. What we are experiencing, and I know others in the industry are as well, is an abuse of that independent dispute resolution process. The No Surprises Act was focused on taking patients who had not chosen a particular provider, think like an ER situation, out of the middle of arguments between health insurance companies like ours, as well as providers on the other side who might not be in network. And that No Surprises Act actually took the patient out of the middle with respect to what they would have to pay when there was a dispute between the insurer and the out-of-network provider. But what we're seeing now is those out-of-network providers, and it's a small portion of them, but a small portion of them are taking advantage of loopholes within the No Surprises Act that we would love to see closed. Mm-hmm. Those are driving costs that are not driving any improvements in outcomes or quality, and it's inflationary. And it hurts, first and foremost, our employer groups that we serve. We have a fiduciary responsibility to deliver to them affordable health care. And so closing loopholes like this is an opportunity for us to work with the administration and others around reducing that fraud and abuse.
So, Catherine, the focus definitely on this arbitration process, as you mentioned, in this particular loophole. Though, given that the providers are winning the vast majority of arbitration cases, as we've seen, do you think that the problem really is that there is a loophole, or is there something more structural of an issue here? Perhaps is it an issue of issuers maybe underpaying in the first place? And is that something that can be found a solution to with what you're doing at Elevance?
Well, that's a great question, Christine. And look, I think there's several opportunities with respect to the arbitration process, so the independent dispute resolution process. Yes, it is a fact that health insurance companies are losing 80+% of these cases, and the providers on the other side are actually winning these cases. Our concern with that is it's a completely opaque process. We have no transparency into why the arbiters are making the decisions that they are. I can say personally that we have done a lot of different pilots to test different amounts to offer providers in this independent dispute resolution process, and it really, frankly, hasn't moved the needle. We have real concerns with whether or not, some of these arbiters are actually PE-backed. They have an incentive, frankly, to continue to drive volume into this process. That's how arbiters get paid. And since providers are the ones who are actually submitting these disputes to begin with, there's frankly a perverse incentive on the arbiter's side to find for providers to continue to drive that volume. So I do think that there are some structural opportunities here. We have shared some of those with the Centers for Medicare and Medicaid Services, who runs the No Surprises Act and the independent dispute resolution process. And I think, there's some real opportunity for us to address this.
All right, Catherine, we have to leave it there. Catherine Gaffigan, President of Health Solutions over at Elevance. health. All right, we do have some breaking news. This involving PayPal. The shares are up about 6% here right now on the back of a report by Bloomberg that Stripe, this is the closely held payment processing company, is said to be considering an acquisition of all or parts of PayPal. This is according to people familiar with the situation, saying that Stripe has expressed preliminary interest in PayPal. And Christine, this is intriguing. This is a private company. It was kind of anticipated to be one of the big IPOs of this year. The most recent tender offer valued it at about $140 billion. PayPal is no, shrinking valley itself. It has a market cap of somewhere in the $40 to $50 billion range here. So this would be a huge acquisition, even a partial acquisition if they were able to pull this off.
Yeah, absolutely. It's very interesting, though. Does this speak to kind of consolidation in a payments business? We know, of course, that PayPal has suffered a little bit from the increased competition in the space, including from Stripe. And so is what we're seeing kind of a bit of the giants eating each other in this space a little bit.
All right, we're going to try to get some more information on this, the net effect of it all. PayPal up about 7% right now. Names like Block and Affirm also rallying here on speculation as well. We'll be back in a moment. This is Bloomberg. Time now for our stock of the hour. Taking a look at shares of Planet Fitness. They've been under pressure all day long. The biggest drop going back to 2023. Fourth quarter results for the company actually did come in above estimates, both on a revenue basis and on the bottom line. But the forecast that the company gave going forward here implies maybe slightly below what the street was looking for. Joining us right now to talk about the health of the business and where it goes next is Colleen Keating. She's the CEO over at Planet Fitness. All right, Colleen, I got to start with the forecast here because that seems to be what the market's reacting to. The EBITDA growth number, about 10% growth on an adjusted basis, but that's below what the street was expecting. There seemed to be this expectation that with some of the pricing changes that you've made, the rollout of the Black Card program, that we would maybe see a little bit more meaningful growth on the bottom line. What's going on?
Well, Romaine, we landed a very strong 2025 and think that's much reflective of the momentum in the business and evidence that our strategic imperatives are delivering. Our first imperative was our brand promise and pulling it through our marketing, and that resulted in 1.1 million net new members for 2025, a 10% lift versus the prior year, and that was on top of a 50% lift in our entry price point, the classic price point, from $10 to $15 for the full year 2025. From a member experience standpoint, we're seeing members utilizing our clubs more frequently. Utilization is up, as is the percentage of members who are rejoining. We're seeing a mid 30% rejoin rate. Our format optimization is resonating. We finished the year with 80% or nearly 80% of our estate with some version of an optimized format and new equipment package. Yeah. And all of this culminates in growth. And we had our highest fourth quarter unit openings number in the history of the company in the fourth quarter of 2025 and finished the year with 181 units. So strong growth. And we remain confident in the 3-year CAGR that we outlined at our Investor Day in November. So, strong momentum.
Well, that's what I'm curious about. I mean, you were obviously going through a bit of a transition here, kind of reimagining the space of meaning the physical space and just really the ethos of what Planet Fitness is. I assume there are costs associated with that. Are those costs permanent, or is this just kind of a temporary thing with regards to the revamping of the locations and any marketing costs associated with it?
Yeah, one of the beautiful things about our model is its high efficiency, and our franchisees have made the investments in the equipment packages to optimize the format. That said, one of the things that we rolled out in 2024 was our new growth model, and this was to help our franchisees with their unit economics and their IRRs. That is one of the things that's influencing our guidance for 2026. This is the first year we'll see a little bit of a push out in equipment revenue. That was intentional, and again, that was anticipated in the 3-year projections that we rolled out.
Now, Colleen, I also want to dig into your membership growth a little bit. You did mention an uplift there, 20 million users, more than 20 million members at the moment. Where do you think the next leg of membership growth comes from? Is it a matter of improving the pricing or perhaps finding new customer segments to penetrate, maybe adding more units?
So a couple of things. So we finished at 20.8 million members, or nearly 21 million members, and our reach is unparalleled. We have a club within 12 minutes of 170 million of the U.S. population, and at the same time, we're in the golden age of fitness. I mean, you can't open a news feed without reading about the importance of fitness and wellness and how it contributes to mental health as well. So interest in working out and fitness and wellness has never been higher. We know that there are about 50 to 60 million people, adults in the U.S. that think about a gym membership and express a willingness to pay. And there are also about 50 to 60 million people in the U.S. who have a gym membership who are in the TAM that we could convert to Planet Fitness as well. So a tremendous opportunity to continue growing membership.
Colleen, only about a minute left, but I am curious as to who you're positioning yourself against here. Like, who are your competitors? Are you going up against the big global gyms, the boutique kind of fitness craze that's popped up? Who?
We are solidly the industry leader in the high value, low price space. At a very approachable price point, we democratized access to fitness while bringing to bear a great offering of top shelf equipment. And what makes us unique is that we have a judgment-free, no gym intimidation environment that's welcoming to all fitness levels.
All right, Colleen, have to leave it there. Really appreciate you joining us today. Colleen Keating, CEO over at Planet Fitness. When we come back, we count you down to those closing bells. A conversation up ahead with Jim Caron, Chief Investment Officer over at Morgan Stanley Investment Management. 10 minutes until the closing bells. Romaine Bostick here alongside Christine Aquino. A little bit of a rebound rally. The market's trying to claw back most of the losses that they had from yesterday.
Absolutely, Romaine. But of course, we have a lot going on today. We heard from Fed speakers expressing caution over inflation generally, and so that's putting pressure on Treasury 2-year. We're seeing those yields up about 2 basis points at the moment. And over in Japan, we also heard caution from the Prime Minister, Sani Takaichi, expressing more concerns over future rate hikes, and that has weakened the yen. It is the worst performer among G10 currencies today. What's having a good day, though, is the NASDAQ up more than 1%, 1.2% at the moment, of course, because of that rebound in tech stocks. And focusing in on AMD as well, that is a big winner today because of news of Meta's investment, purchasing chips and shares in a company. That stock is up nearly 9%.
Absolutely. In fact, most of the leaders in the market today you're going to actually find in that tech space, including AMD. And of course, that news we just broke on PayPal, a potential bid by Stripe for all or parts of the company. Joining us right now to count down to the closing bells is Jim Caron, Chief Investment Officer of the Portfolio Solutions Group over at Morgan Stanley Investment Management. Jim, great to have you here.
Good to see you.
It's an interesting week because we are going to start to get some earnings out of some of these software companies that have been beaten down, Salesforce, Workday, a few others that I'm forgetting here. And it gets to this idea as to whether I guess the sell-off that we've seen, effectively a bear market that we've seen in a lot of these software names, is warranted, or are people just kind of getting maybe a little bit too ahead of themselves with the pessimism?
Well, I mean, I think we have to start with a baseline that maybe some of these software companies did have very high multiples, around 30 PEs. That's got trimmed back down to around 15. So I think there's been a reasonable sell-off in the overall space. But I think the way the market is looking at this is they're thinking about this as something that could become a systemic event or something like that. I don't see it that way. So effectively, whenever I see an event like this is one sector in the market that's moving, I always ask the question, is there a contagion? Or is there a dispersion, in which case I can diversify the risk? So is this sell-off in the software sector, is that infecting the credit markets? Is it infecting liquidity? Is this going to become a leverage issue across a broad swath of sectors in the markets? We're not seeing that. In fact, we're seeing the publicly traded credit markets are trading just fine. Liquidity is just fine. So I do think that there has been a setback from high valuations, but I don't see the contagion. So I don't really see this as a broad-based sell-off with a long gestation period that could bring down the market substantially further.
What do you think people are looking for, though? I mean, I understand valuation is part of it, but there's something more there.
So look, I mean, I think people are really trying to evaluate the creative destruction that's coming out of all of the various, different large language models and what have you. And what people I think are misunderstanding in this whole thing is that there's also an opportunity set that comes out of this too, right? So there's probably a lot of future jobs that we can't even think of today that are going to be there for us. But this whole idea of this halo trade, this heavy asset, low obsolescence. Well, yeah, I would like to invest in things that have low obsolescence, but I also want things with a high growth rate. So how do I get something with low obsolescence and a high growth rate? Well, yes, if you have a very unique product, fine, but there aren't a lot of those. So in general, if you invest in a lot of things that are not subject to creative destruction, then you're probably not going to have a very high return on your capital either, right? Because the growth rate just isn't going to be there. So I think people have to understand that creative destruction, and with all this AI stuff that's going on, effectively get used to it. It's going to disrupt a lot of things. The question we have to ask ourselves is it disrupting areas that have a lot of leverage that will then create contagion across markets? If not, then we have to figure out ways to construct our portfolios and manage around it.
Yeah, well, to your point about leverage, I know that is one of the risks that you pointed to in the market at the moment. Which sectors do you think are kind of exposed to that particularly, and also exposed to the AI disruption risks that the market has been fretting about?
Well, I mean, the most apparent way, I wish I had a clear roadmap as to what that is. We're all trying to solve for that. So clearly the one that we're all talking about today is software, because we thought they had a moat around their business. The other areas that we're going to think about are other fields that we believe just don't have a very, very strong moat. And a lot of these are more these labor-intensive jobs that might, come under pressure and come under threat. But as investors, as asset managers, as investors in equities, what we're trying to look for is margins and profit margins and growth rates. I think there will be a lot of creative destruction in the markets. There always has been. This is healthy. What we're looking to do is diversify our portfolios and find good value companies that can actually unlock the technology advantages and create operating leverage, and therefore get higher and better returns. And I think that's the key. So I don't think we should run away from this or hide from it. I think we should embrace it. And we just have to understand how we need to diversify our portfolios around this risk of, obsolescence and things like that. Look, creative destruction is not going away.
Now, you also mentioned credit markets looking healthy, at least the publicly traded side of it. Private credit, though, seems to be a different story with all the Blue Owl stuff going on. Is that a particularly, a source of contagion risk at some point?
Yeah, look, I mean, people are going to look at the private credit markets a lot, because they've tended to take on higher levels of leverage in what they've funded, right, in terms of the investments that they've done, where the publicly traded markets haven't. So, for example, high yield only has about 3% exposure to software. Private credit has somewhere upwards of 20%, right? So it's a question of that manageability in that space. So look, it can be, but still, much of the private credit market is very isolated and it's very bifurcated, right? So you can't just paint it with the same brush and say all of private credit is bad. It depends on the manager, it depends on what they bought, depends on what their business model is. There's all different flavors of this. So what we're seeing in the markets today is that many of these private credit opportunities, or even direct lending opportunities, are trading at significant discounts to their NAV. Now that creates an opportunity, as long as we do our credit homework and we understand what they invested in and where they have the leverage. And refinancing is another risk too, and I think that's what the market's worried about. But if you can avoid some of those big refinancing, walls, essentially, I think that there's a fair amount of opportunity out there.
Well, we only have about 30 seconds, but with regards to just overall sentiment in this market right now, what does that scream to you? Is it defensiveness? Is it what?
So, I mean, it depends where we're looking for the sentiment, right? So if we look in terms of investors are jittery. We can see the vols a little bit higher. If I look at consumer confidence, Conference Board came out with numbers today, very, very strong. If I look at the small business NFIB surveys in terms of hiring and hiring needs and hiring potentials, all very, very strong. So the sentiment for investors that might have invested in some of these, like maybe the Mag 7 where prices got a little too high, they're worried. But for the broader market, the other 493 seems to be doing just fine.
Jim, always a pleasure. Jim Caron, Chief Investment Officer of the Portfolio Solutions Group over at Morgan Stanley Investment Management, counting us down to the closing bell. It's just about 2 minutes away. Stocks holding on to gains on the day. Some big boosts today from Apple, Nvidia, Microsoft. Some drags, though, from a lot of the chip makers today, including Texas Instruments and Broadcom. A full breakdown of all of today's market action, a full breakdown of earnings, starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Christine Aquino, taking you through to that closing bell with the global simulcast. We're joined now by Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube, here to parse the most crucial moments of the day. A rebound rally here on this Tuesday afternoon, and some big earnings up ahead that could maybe aid or hinder further gains.
Yeah, I think about that, right? Workday, Lucid, GoDaddy, Cava, HP Inc. We're going to get those earnings after the closing bell. We'll see what it says, but certainly any of those that play into the AI world that can give either some support or create some new worries. But it does feel like the AI scare, definitely not a part of the trade today, but we'll see what tomorrow brings.
I was just going to say, wait till tomorrow and we'll see what new tool comes from Claude and Anthropic. Hey, I do want to take a look at Bitcoin as we do get toward the end of the month.
Yeah?
It's heading for the worst month since the crypto collapse of June of 2022. Down about $90 today, or as we speak. 64,471 is where it's hovering.
Yeah, well, tech still very much the story for me today, of course. Looking at that Meta AMD deal, I mean, very interesting that Meta not only buying chips from AMD, also buying shares. If there's any concern about circular funding, it's not showing up today. Both of those shares up and going with the gains that we're seeing in the broad market.
I also want to make sure that everyone keeps their eye on what's been going on in the healthcare space. So one of the weaker sectors, particularly when it comes to insurers, we are expecting that State of the Union speech tonight. Typically more sizzle than substance, but a lot of talk here about the president's push for affordability and how insurers, health insurers, might be right in the crosshairs of that. As we await those earnings, let's walk you through the numbers here on this Tuesday afternoon. The S&P looks like it's going to close higher by roughly about 50 points, or about 0.8%, clawing back most, but not all, of the losses from yesterday. The Dow Jones Industrial Average up a similar percent, about 0.8% on the day. The NASDAQ composite adding about 1%, and the Russell 2000, Carol, up 31 points, or 1.2%.
All right, good stuff. Let me go back to the S&P 500, Romaine. Taking a look inside this index, most names in the S&P 500 higher today. In fact, 356 gaining ground on this Tuesday. Romaine, 145 to the downside and 2 unchanged.
Yeah, consumer discretionary stocks, that is your outperformer here on the day, with 9 of the 11 S&P sectors in the green. Industrials and tech also getting in on a lot of action, but to the downside, it was energy and healthcare.
All right, guys, let me go to some of the individual gainers. AMD, number 2 gainer in the S&P 500. Also, the number 2 gainer in the NASDAQ 100. This one rallying almost 9% in today's session. You know the news. Meta Platforms will be spending billions of dollars on AMD gear and has plans to buy AMD stock. Meta is going to deploy data center gear based on processors from AMD in a deal worth double-digit billions of dollars per gigawatt. Get into the story. It's on the Bloomberg, all the details, but definitely moving that name. And I know we got some earnings.
Yeah, we actually got Workday, of course, the application software company, out with the results here. Remember, this is a stock that has actually been decimated, down 39% just to start the year. And it looks like in the after-hours trade, it's moving even lower. The company says that adjusted EPS in the most recent quarter did come in above estimates, $2.47. The street was looking for $2.32. Revenue did grow at about a 15% clip to $2.53 billion. That's relatively in line with estimates. Subscription revenue on the nose as well at $2.36 billion. The company, though, saying that for the current quarter, the fiscal first quarter, it sees $2.34 billion in subscription revenue. And for the full year, okay, this is the real guidance here. Yeah. For the full year, subscription revenue of $9.9 to $9.95 billion. The top end of that range is below the average of street estimates. The street was looking for $10 billion on average, Tim. And on an adjusted operating margin, the company says expect about 30% for the full year. The street was looking for about 31%.
So it's one of those companies, as you mentioned, that people have been concerned that could be displaced or at least disrupted by AI. AI. Shares down about 8% in the after hours. The company now calling itself the enterprise AI platform for managing people, money, and agents. The statement in the press release coming from the company's co-founder, CEO, and chair says, quote, "We built Workday to bring innovation back to the worlds of HR and finance, and AI gives us the chance to do it all again. We operate at the heart of global enterprise. It gives Workday a unique opportunity to bring AI directly into the HR and finance workflows our customers rely on every day and to deliver real, measurable value." From a communications perspective, we hear from these software companies over and over again, we're not scared of AI. We're embracing AI. That's the message that they want investors to get. It's just not clear if investors are buying it.
Well, investors have been sending a pretty clear message. I mean, the stock's down about 40% year to date and taking another 9% to the downside in the aftermarket. So that message pretty clear, but we'll see what else we get maybe on the call with analysts and investors to see if there's more clarity around that AI component. All right, I'm going to go, as we wait for some more earnings, go back to a few other gainers in today's session. Ticker KEYS, Keys, Keysight Technologies, number one gainer in the S&P 500. It's a measurement instruments company, and this stock surging 23% in today's session after it forecast fiscal second quarter earnings, which beat the average analyst estimate. It also reported stronger than expected first quarter results. Speaking of AI, booming AI workloads, along with faster growth in other business areas, including wireless and defense, are all boosting growth, according to analysts for this company. And one more, this was your number one gainer in the NASDAQ 100, Thomson Reuters, ticker TRI, stock up about 11.5%, shares soaring on heavy volume in today's session, biggest intraday gain too in about 17 years. Company said it reached 1 million professional users of CoCounsel, its legal and business artificial intelligence tool, and announced that it was working with Anthropic's Claude model. Stock still down, though, about 31% year to date. But AI just in everything, and it definitely gets stocks moving, sometimes to the downside, sometimes to the upside.
Well, let's look at some stocks that did move to the downside today. It wasn't the worst performer in the S&P 500, but among them, Texas Instruments down close to 3% on the day today. This after the company indicated that spending on new plants and equipment will remain higher than some investors had anticipated. The company gave a presentation on Tuesday and said that expenditures will be $2 billion to $3 billion this year. That was the previous stance. Over the last 4 years, it's increased spending far above historical levels, citing the need to bring manufacturing back in-house and reverse an outsourcing trend. Also, taking a look at shares of Whirlpool Corp on the day today. This after it said it launched a concurrent separate underwritten public offerings of common shares and depository shares. Shares fell by close to 14%. The depository shares each represent a 1/20th interest in a share of a newly issued Series A mandatory convertible preferred stock, and the proceeds aggregate from the offerings are anticipated to be $800 million. And finally, Novo Nordisk and Eli Lilly both falling today. This after Novo said it plans to slash the U.S. list prices for its blockbusters Wegovy and Ozempic next year by as much as 50%. Novo Nordisk ADR is down 2.6%. Eli Lilly down 1.6%.
All right, not much movement in yields today, down up about 2 basis points on the shorter end of the curve, up about 2 basis points on the longer end of the curve. We are continuing to get some earnings. This on electric vehicle maker Lucid, the company reporting an adjusted loss in the most recent quarter of about $3.08 a share. That's wider than what the street was looking for. Revenue at 522, we'll round it up to 523 million. That's actually a beat. The street was looking for roughly about 459. Production of vehicles right now for 2026, company says look for about 25,000 to 27,000 vehicles. The shares down, though, about 6 to 7% in the after-hours trade.
All right, let's go to some more earnings. Sanger out with its results, and we're looking at fourth quarter total revenue, 160.3 million. Folks, that's a beat. Street was looking for 146.2 million. Right now, the stock unchanged as these headlines just start to cross the Bloomberg terminal. And also I'm looking for a little bit more clarity in terms of some of their results. Again, the stock unchanged here, but it looks like they are beating estimates in some metrics. And just taking a look real quick, again, not really much of a trade here. Stock is up about 6.5% so far year to date. This is a retail REIT. Of course, you know, their outlets and so on and so forth that are around. So good read on the consumer, but also on the REIT market. But right now, again, not much moving on that stock here unchanged in the aftermarket.
Let's just go to GoDaddy right now, up about 0.8% in the after hours. The outlook, the company sees first quarter revenue 1.25 to 1.27 billion. That's just shy of estimates of $1.28 billion. Shares down about 1% in the after hours. Looking backward, fourth quarter revenue came in line with estimates at $1.27 billion. Fourth quarter EPS did come in above estimates at $1.80.
All right, just going quick back to Workday, if I may, because we're seeing that stock definitely moving a bunch in the aftermarket. You still got it down about 6.7%. We went through some of the metrics, but again, the outlook sees 2027 subscription revenue 9.93 billion to 9.95 billion. Street estimate was at 10 billion. And also looking at 2027 adjusted operating margin of 30%. That's below the street estimate of 31.1. So the stock, as we know, has been beaten up in this year already, down 40%, but we're looking at some more selling in the aftermarket. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call up the closing bell. Romaine and Christine continuing there on The Close on Bloomberg Television, and Tim and I continuing right here on Bloomberg Business Week Daily on Bloomberg Radio. We will see you again, same time, same place tomorrow.
And we're still awaiting some additional earnings, including out of HPQ, HP Inc., and results out of the restaurant chain Cava. We're going to dive deeper into those results. When we come back, stick with us. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostick. A bit of a rebound rally in markets on this Tuesday, coming off that Monday sell-off, a sell-off that was largely led by a big drop in some of those software names. You take a look at the second line on your screen there. Application software makers as a group up about 1.5%, but don't worry there. We're still deep in a bear market in that space here, and a lot of questions here as to just how much further this can go. The S&P closing up about 0.8% on the day. Healthcare stocks have been under pressure for the last 3 days, including the 3% drop today, and Bitcoin still mired in the mud. When we talk about some of the individual movers, you did see a big pop in AMD, that deal with Meta Platforms that we learned about to start the day. That gave a big boost here. But freight brokers, Expeditors International, still under pressure. This is that tariff story, and there's going to be a big focus tonight on what the president has to say at his State of the Union address about some of his policies, particularly when it comes to tariffs as well. Blue Owl trying to get its mojo back with a gain of about 3% on the day. And if you talk about the idea of risk sentiment, risk appetite, Rich Sparkle Holdings, one of the meme stocks, up about 50% on the day alone. Meanwhile, in the after-hour session, we did get those earnings out of Workday. We're going to dive a little bit deeper into that in just a few minutes. But to see the drop there, down about 7% here. Overall, the numbers weren't bad, but some of the guidance here just a little bit too narrow for the street's liking. Lucid Group still making losses and only projecting about 25 to 27,000 cars built on for the full year. And at the bottom of your screen, Cava. Those earnings just crossing the wire right now. There's been a lot of talk about the health of the fast casual restaurant space. The company saying that in the most recent quarter, adjusted EPS did beat at about 4 cents a share. It also said that revenue did beat at about $275 million. But here's the guidance. For the full year, 2026, the company says expect comp growth of about 3% to 5%. Comp sales of 3% to 5%. Coming into this print, the street was looking for roughly about 2.75%. Those shares up right now, about 9% here in the after hours trade. Let's get some insights here into those numbers and what investors should expect next. Nick Setyan joining us right now, Managing Director of Restaurants Equity Research over at Mizuho Securities. All right, not a bad number here, 3 to 5% growth rate, not just because it's above what the street was looking for, but quite frankly, we came into this year with some dour expectations for a lot of these fast casual names.
Yeah, well, thanks for having me, first of all. It is. The Q4 itself, a slight beat in terms of the comp, 2026 comp guidance. Again, 3 to 5% versus right below 3% consensus. And importantly, it does address a lot of skepticism and fears around this fast casual category, and Cava is no exception.
When we talk about what's been ailing this space, is it about price, or is it just kind of, fatigue? We're all kind of fatigued with, bowls and sort of the traditional offerings. What's going on?
I actually do think it's price. Cava's one player within fast casual that has taken less price than anybody else. So it's not necessarily too much of a surprise that its comp would outperform. But within the space, both Chipotle and Shake Shack have led the way with pricing over and above grocery when really they didn't have to. And I think it's coming back to haunt the rest of the group. But Cava really is a standout.
I am always curious, too. I mean, we've spoken a lot with the Cava CEO, and we're going to have him on the program tomorrow, about sort of the geographic mix of their restaurants, and that to a certain extent it gives them a certain advantage, that they're basically in places where there aren't as many food options as, say, being in, a central area like New York City.
I think they've taken a pretty balanced approach. They're both in urban and sort of suburban and not more regional areas. And across the board, they've done really well. And as they expand, into both areas, the new unit volumes continue to outperform expectations. So Chicago, for example, in 2025, those new unit volumes far exceeded almost 2 times their new unit targets. So across the board, both new units and comparable sales, tend to outperform at Cava.
What do you expect from this company going forward, Nick, with regards to their expansion, their growth strategy, and what do you want to hear on the conference call?
Well, they're comparable. Their advantage really is that sort of relative value. They take less pricing than the peer set year in, year out. They can do that because of their more diverse COGS basket. So they're not as exposed to inflation year in, year out. I expect them to grow EBITDA 15% plus, again, every year for the foreseeable future. And as long as that's intact, I think the stock's going to be fine. It is a little bit, it is a little expensive, so it's always a little tough to figure out what valuation is appropriate for such an outperformer. But it is an underperformer.
All right. Well, Nick, we'll let you get to it. Nick Setyan, Managing Director of Restaurants Equity Research over at Mizuho Securities. We should point out Cava, one of the biggest movers now to the upside in the after-hours trade, up now about 8%. Meanwhile, let's take a look at HP Inc. HPQ is the ticker. The share is slightly higher here in the after-hours trade after the company said that for the current quarter, the fiscal second quarter, it sees adjusted EPS of 70 cents to 76 cents a share. The street was looking for 75 cents. So basically, the company, to a certain degree, guiding, at least on the upside, to slightly above the average of street estimates. As for the most recent quarter, it did beat the fiscal first quarter adjusted EPS, coming in at 81 cents a share. The street was looking for 77 cents a share. Operating margin did come in a little bit light, though, at about 6.9%. The street was looking for about 7.38%. And revenue in the most recent quarter did beat at about $14.4 billion. The street was looking for roughly about 14 even. I also do want to point out, too, when it comes to that forecast that they're giving, not only for the quarter, but they're also providing a full year adjusted EPS estimate of $2.90 to $3.20 a share. The street on average was looking for $3 here. So not a huge beat and raise here, but definitely guiding slightly to the upside of what the street is looking for long term. But we'll have to get a little bit more information out of this company in just a second when we get to that conference call. We're also getting some results right now out of ticker SAM. Of course, this is Boston Beer. Let's go to that right now. The share is slightly higher in the after-hours trade. A beat on the top line in the most recent quarter, $385.7 million in revenue in the quarter. That's slightly above what the street was looking for. The company says that for the full year, expect EPS for 2026 of $8.50 to $11 a share, and says gross margin should expand to about 48% to 50%. We'll get you some more details on this. And when we come back, we're also going to take a deeper dive into those results we got out of Workday and the big question right now about a lot of these software stocks and whether they truly are being disrupted by all of these new AI tools. That conversation coming up next here on The Close. This is Bloomberg.
The markets have been selling software for almost a year now on the AI threat, but they really accelerated in the last few weeks. And this is, the problem with this, if you're long software, is there's nothing to actually disprove the thesis because the thesis is a few years out.
And that was the co-author of a Citrini research report that fueled that big sell-off that we saw yesterday in a lot of those software stocks. Of course, it comes on an auspicious time. This is the week where we start to hear from a lot of those software companies, the application software companies, the software as a services companies. We just heard from Workday, and while the numbers certainly weren't bad, the guidance certainly not anything impressive to go forward with. Our next guest is warning that the price action in markets is not actually the deflating of an AI bubble, but rather just disruption causing a repricing. Jack Janasiewicz joins us right now, lead portfolio strategist over at Natixis Investment Managers Solution. And Jack, I don't know if you want to go back to the halcyon days where, you just pick any sort of stock in the AI space and you were probably going to make a fortune. That seems to be over. And it gets to this idea of what we're actually seeing in this market. This isn't necessarily a wholesale people turning their back on AI. Is it just a little bit more, I guess, scrutiny and I guess discerning when it comes to who might actually benefit the most from a lot of these AI infrastructure build out?
Yeah, and I think we actually call it the 3 Ds, right? It's a disruption, dispersion, and derating. We're seeing the disruption backdrop because of a lot of this is driven by just the uncertainty about what the future is going to look like. We just don't know. And as a result, I think investors are sort of one finger on that sell button, right? Sell first, ask questions later. And while we're in the midst of doing that, we're also creating this bifurcated market, right? You're having a bunch of winners and a bunch of losers. That's creating this dispersion in returns across everything. And ultimately, it's just relating to a derating of the overall backdrop here. And I think until we start to see more clarity on the earnings going forward, that's going to be this chop going forward. That the triple Ds, I think, are going to be here with us for some time.
There's been a lot of talk, and I don't know who coined it, but at Goldman Sachs has been talking about this halo trade, the idea of looking for folks that have a little bit less obsolescence or less risk of obsolescence. And this has actually pushed a lot of folks, not out of the AI trade, but certainly to companies that I guess aren't necessarily going to be disrupted by whatever, Anthropic Claude tool comes out, whether it's, a water company, a land company, energy company, if you will. Are you finding opportunity there?
Yeah, and I think that sort of makes some sense because the macro backdrop's still fairly supportive, right? And so rather than sort of taking these risks where you could wake up one day and your individual names are down 20% because all of a sudden some announcement on some AI agent comes out, you can still hide out in other places and not really get left behind, so to speak. So I think the macro backdrop is really allowing investors to sort of hide out in other places, still getting decent returns while letting the dust settle and looking for more clarity on these AI-related issues that we're talking about.
What did you make, Jack? Like when you see those reports out of Citrini and a few others, which, again, hypotheticals for the most part. I mean, this is almost basically scenario analysis. But I'm curious not only what you thought of the report itself, but of the market reaction to effectively a hypothetical set of scenarios.
Yeah, and it doesn't surprise me, given the state of uncertainty that we're seeing. You're seeing volatility creep up based on what we're seeing out of the VIX. There's a little bit of concern about just, that lack of clarity that I keep talking about here. It's not surprising that we had a little bit of profit taking, a little bit of weakness in the market yesterday. But regarding the report itself from Citrini, it's an interesting thought exercise. Reading through that over the weekend, I was like, oh, I never thought of that impact. Again, we're talking 3 to 5 years out. A lot can happen between now and then, and certain things are going to probably manifest as was written in there, and some of the things aren't going to play out. So as always, the truth probably lies somewhere in the middle, but it's a great thought exercise to walk through just to look at the tail risks from both the upside and to the downside.
It's kind of interesting, too, Jack, to see the reaction that we saw Monday out of that, and then kind of the reaction we saw today, partly because of the live stream that Anthropic had, which seemed to kind of suggest that a lot of these tools are going to be more in unison with some of the traditional kind of software suites, and not necessarily, at least in the short term, not necessarily kind of the death of them.
Yeah, and I think what came out of that meeting was basically, a partnership, right? I think that was the key term that they were using to describe the linkages between enterprise software and AI going forward. And I think that puts a little bit of credibility back into the software names, but I think maybe holding that area forward is sort of show me now, right? And you want to see actual tangible results, and that might mean looking at revenue growth over the next couple of quarters, waiting for some of those earnings estimates to maybe turn back higher and really see what the AI adoption looks like. And so it's sort of in this prove it stage right now, and we might need a couple of quarters of actual reporting and hearing from CEOs before we actually get that sort of confidence to sort of say, okay, maybe software isn't going to be sort of annihilated, not made obsolete in here. So more chopping wood.
Do I put any faith in what NVIDIA has to say tomorrow, or is that just kind of the old story now?
Well, I think, again, the AI CapEx spend is still one of the key supporting backdrops for the U.S. economy. And, you have to reach a happy medium here. The market seems to be punishing excess CapEx because of the ROI questions. But at the same time, if we see a massive slowdown in CapEx, that's really one of the big growth engines. And so we could actually start to see the U.S. economy slow. So careful what you wish for here.
All right, Jack, got to leave it there. Jack Janasiewicz, lead portfolio strategist over at Natixis Investment Managers Solutions. We have to get to some breaking news right now. This involving Warner Brothers Discovery and that bid by Paramount Skydance to up Netflix. Warner Brothers now confirming that bid has been boosted to $31 a share. And it says, I'm going to be very specific about this, that the Paramount proposal could lead to a superior bid, though it is saying right now that it plans to stick by its existing agreement with Netflix here. So a bit complicated here, but we talk about this idea of, at least on a financial basis, Warner Brothers giving at least a nod to the potential superiority of the Paramount bid, but at least for right now, saying that the Warner Brothers board still recommends the Netflix transaction and that Netflix merger pact remains in effect. Warner Brothers shares slightly to the downside, Paramount Skydance shares slightly to the downside, Netflix shares up about 1.3%. Stick with us. We're going to get you some more details in just a second. This is The Close on Bloomberg. All right, breaking news just a little while ago. Warner Brothers Discovery responding to that elevated Paramount bid of $31 a share. Warner Brothers saying that the Paramount proposal could lead to a superior bid. Let's bring in Chris Palmeri, our man out in Los Angeles, to talk a little bit more about what we know. So first, let's get one thing straight here. Is the Netflix deal still on the table?
Yes, right. They have not canceled the Netflix deal. What they've said is this could lead to a better deal with Paramount, and so we're going to keep talking to them.
I am curious about the conditionality of all of this. The idea that they have a bid, the numbers are there, it's either superior or it's not. What's the issue?
It's obviously the Warner Brothers board is not completely convinced that they're there. They maybe think they can get a little bit more out of Paramount. It certainly seems that way. This is an extraordinary offer here. Paramount's not only raised the price $31 a share, they raised the termination fee if they don't get their deal done due to regulatory concerns. They're also agreeing to pay $2.8 billion to Netflix to get them out of that deal. So it's just a real indicator of how much Paramount wants this.
I am curious about what we've heard, if at all, from Netflix. I know Ted Sarandos was on Bloomberg last week, the co-CEO over at Netflix. Do we have any sense as just to how far they are willing to go with this in terms of fighting to keep this deal intact?
They've been asked many times, what's your top price? And they've been, understandably reluctant to say that. All we can say is from all of the effort they're putting into saving their deal, all of the TV appearances and meetings with investors and efforts to say that they really want this, the Netflix is still in the game.
Is there any sort of deadline that we should be looking to now, Chris, where maybe we do get a little bit more clarity, if not a definitive outcome to this whole saga?
There is a clock that will start ticking at some point. If the Warner Brothers board determines that the Paramount offer is superior to Netflix, then Netflix has 4 days to respond. It won't be all over then, because even then Paramount could come back and come with a counter bid. But there is some effort to put a timeline on this.
All right, Chris Palmeri out there in Los Angeles. Of course, the breaking news just crossing the wire. Warner Brothers officially responding to that sweetened offer by Paramount, $31 a share that it says could lead to a superior bid, though at least for right now, the Netflix deal still on the table. All right, let's take a quick look at some of the after-hours trade. Warner Brothers to the downside. Netflix has been oscillating between gains and losses, now up about 1%. And, of course, with some of the earnings that we just got, HP Inc., of course, that is the part of the business that makes the printers and computers, down about 6% here in the after-hours trade. But keep an eye on a lot of the software names. So you take a look at Workday there, down about 7% after reporting earnings. Most of the key metrics did beat, but the guidance was a little bit tight, maybe a little too close for comfort for some investors out there. And don't forget, we're going to get Salesforce tomorrow, as well as a few other names in this space. So something to keep an eye on, given the big software ructions that we've seen over the last few weeks. We'll be back in a moment. This is Bloomberg.
I think the job market is pretty steady. I think growth is pretty steady. I think there's some promising stuff in the inflation reports, but there's also some warning signs. So, as I say, I'm not hawkish about rates. I'm pretty optimistic that we can get rates down further, multiple cuts in 2026, as long as we see the progress on inflation.
Chicago Fed President Austin Goolsbee speaking a little bit earlier with our very own Michael McKee about the state of the economy, coming, of course, right ahead of the president's State of the Union address, which is just a few hours from now. Here to get some insights into maybe what we will hear or maybe what we won't hear is Stephanie Kelton, professor of public policy and economics over at Stony Brook University. All right, Stephanie, this is a speech largely being billed as supposedly about affordability and the economy, two hot button issues, of course, that are going to sort of have a big factor in the elections coming up. I am curious if you've heard about any of the potential proposals that might be floated by the president, including additional tax cuts, not only for corporations, but also for individuals that could, if at all, have any real impact on the economic situation.
I mean, well, he's talking a little bit, or at least some Republicans are talking a little bit about ways to make permanent things like no tax on tips, no tax on overtime, no tax on Social Security. So you're starting to hear some of that. Whether that will make its way into the speech tonight, I don't know. There's also been some speculation about possibly hearing the president talk about expanding on this idea of the Trump accounts, the accounts that were so far set up on a temporary basis for newborn children, but expanding them to be sort of Trump accounts for adults, maybe resuscitating an old idea, the sort of MyRA that we heard about many years ago when Barack Obama was president. So, yeah, I think you're going to hear teasing of some new ideas on the tax side for sure.
With regards to these ideas, and obviously with the caveat that a lot of these State of the Union speeches, they're long on promises. And of course, once you get to the substance of it in the days that follow, they tend to wane a little bit for any president, not just Trump. But I am curious as to whether any of these ideas would have any real material economic tailwind for us.
Well, I mean, sure, I think they could. You know, you start talking about doing things on the regulatory side, on tax cut side. There's no reason why, if Republicans weren't able to push further in those directions, you wouldn't see benefits, at least short term and maybe even beyond in the real economy. So, yeah, I think that's a reasonable to expect that if the speech turns into something more than just rhetoric and it actually becomes part of a future piece of legislation, then sure, it would have material implications for the economy.
You know, we played a little bit of a clip from Austin Goolsbee. There has been obviously a big focus on the Fed, partly because of Trump's insistence on the Fed cutting rates sometime soon. When you look at the job market, and for that matter, when you look at inflation, is there a case to be made for any sort of material easing in Fed policy?
This is the great Rorschach test of 2026, isn't it? You know, I did not catch Governor Cook's recent speech, but I did see some headlines after her remarks. And, you know, what did she say? Something like, if the productivity growth boom is really there, maybe neutral rates are higher, and if inequality continues to increase, maybe neutral rate is lower. So it's, the kids say what do the kids like to say these days, 6, 7? I don't know. I guess it's something like that.
Yeah, that's a good one. Well, yes, and to that point, though, it also gets to the idea here, Stephanie, of kind of just the complexion of an economy heading into an election year, and the idea of the difference between what the economy actually is and the perception that voters have, because we've seen many candidates tripped up in years past, not by the reality, but by the perception.
Yep, that's a place where I think policymakers in general need to be very careful. And I imagine folks have talked with the president about the need to not be dismissive of the, you know, affordability crisis. If people tell you that everything is not okay, we've learned that it's not a very good idea to tell them that they don't really understand their lived experience. They don't understand how great the economy actually is for everyone. I think, you know, a lot of folks are looking at this economy and seeing an economy that continues to work really well for some portion of the population, especially, let's say, those at the top of the income distribution, let's say the top 10% or so, things are good, but people really are struggling. They're struggling with affordability when it comes to healthcare, when it comes to housing, food, energy. Those are real hardships for a lot of people in this country. And I think it would be a mistake for anybody to dismiss those kinds of concerns. So, you know, perception, what's the saying? 90% of reality is perception. So you have to acknowledge that.
All right, Stephanie Kelton, professor over at Stony Brook University. And just a reminder, we are going to have full coverage of the State of the Union address, which starts at 8 p.m. Washington time. And of course, once the president finishes up his speech, the plan is to set off around the country, first with the trip to Texas on Friday, aiming to double down on the messages in that speech, particularly amid some very, very heated races heading into the midterm election. Our next guest wrote a book on counter-messaging strategies, growing more critical by the day as the midterms draw near. He's the author of the book Strong Floor, No Ceiling, and co-founding managing partner of HL Ventures and City Rock Venture Partners. Oliver Libby joins us right now here in Studio 2. And I do want to focus on the counter-messaging. I mean, to a certain extent, we kind of know what Trump is going to say. He's already kind of tested out his affordability speech, if you will, over the last couple of weeks. I'm also curious, though, what the Democrats' rebuttal, if at all, will actually be. What are they going to say?
Well, thanks for having me, Remy. Yeah. First of all, I don't know that there is actually a unified message. I mean, one of the things I've noticed is there is not just one response to the State of the Union tonight. I think Governor Spanberger is giving one of them, but there are—
The Virginia governor.
That's right. Yeah. There's 3 or 4 more, and then there's also a big—
What do you mean 3 or 4 more?
Responses. There's one Spanish language. There's several other folks who are going to give big speeches tonight, and so there isn't yet that unified message, which I agree with you is critical. I do think, and I hear in Democratic circles, that there is a lot of work on what is the message going to be. One of the things that I've seen coalesce, though, and Dr. Skelton actually said it in your last segment, is affordability is key. And people are understanding that if you can't put food on the table, if you're struggling, then you don't care about democratic norms or whether we strike Iran or anything. And so whatever we hear tonight from Democrats is going to hammer that home. And the last thing I'll quickly say on this is the president certainly is going to say, I mean, first of all, affordability was a hoax and then it was solved, right? But what we're going to hear probably is a lot of the things that he has proposed. And there are executive orders like the 10% limit on credit cards or going after institutional home buyers. We need, I think, what we're going to be hoping for folks to say tonight is that those things won't translate to actual differences for people's lived experience.
Well, that's what I'm curious. And it gets to this idea of what the Democratic Party is doing. I mean, these ideas have been floating around out there. And it's one thing to sign an executive order. And to Stephanie's point, too, I mean, some of these things probably should be, if you are serious about it, codified in legislation to actually make it work. But we've kind of seen this idea, right, that, Trump will talk about winning affordability. I've done this, I've done that. And then people are still going to the grocery store or they're buying this and buying that. And they very clearly know that prices are higher than what they were a year ago, 2 years ago, or whenever. So why haven't the Democrats been able to sort of cut through that and sort of make it known, at least, in their view, that they can actually do something about it?
I think that it's a great question. One of the things that is critical for Democrats to do is to move from the criticism to showing what they're going to do. I actually think they have landed the argument. If you look at last November with those 2 gubernatorial races, with the PUC races in Georgia, even the mayoral election here in New York, I think you saw broad electoral victories and even doubled down on by this Texas special that was so overwhelmingly Democratic. So I think the argument, the kind of the anger-based argument has started to land. But mark my words, there has never been a seismic shift in American politics that came just from anger and frustration. However, rooted in truth, that anger is. You have to go to the plan, to the hope. That's the New Deal, the Great Society, 6 for 06, even the contract with America. It's never happened without that.
But what does that look like, though, right? Because some people will look at when Harris ran, when Biden ran. I mean, they had plans. They were, a little muddled and very detailed to the point where I think it kind of a lot of people glossed over it. I mean, you mentioned 3 key plans. Those are distilled down into slogans, to the most part. There was substance underneath it, but there were slogans that people could wrap their head around. And I have yet to really see that out of the Democratic Party.
Well, look, strong floor, no ceiling is my attempt to help codify that for the party. But I will say, and by the way, for anyone in the center who wants practical policy, look, there is a tendency amongst the Democrats to respond to 4 words with 5 paragraphs, right? And that is something that they have to resist. And we should be listening tonight to these responses to see if they actually do that. Because at the end of the day, the anger and the frustration is there. If there is no plan, if there is no short, pithy way to get people on board, then there won't be success.
Who's running the show over there, though? And I'm going to go back to the contract of America. When I first moved to Washington, I lived in Washington, D.C. for a time. Literally the first week I was there was the exact day where Newt Gingrich was out there in front of the Capitol with the big contract with America sign. And I remember just walking by and not knowing anything about politics or something. He was the ringleader, and he really pushed through an agenda, rightly or wrongly, that resonated with a lot of people. I don't really see that right now from the Democratic Party. Who is that person? Is there a person?
Right now, I would say you've seen a good partnership between Leader Hakeem Jeffries, Democratic leader in the House, and between Senator Schumer. I think Leader Jeffries has taken big steps. I mean, I was very heartened to see him actually talk about strong floor, no ceiling quite a bit. So I think he and his team are absolutely, kind of leading the charge here. And one of the things, going back to what you said about the Harris campaign and Biden, and you were just talking about it, is you can't start by denying people's lived experience. I mean, part of the big mistake at the last election cycle is when we kept hearing everything is fine. And President Trump has, I think, made a lot of the same error. So the first person, the first party that is able to say, no, things are not going well, you have every right to be very upset, but here's what we're going to do. And to your point, very specifically, and in my view, it should be a strong floor. And the planks are very clear. It's education, it's healthcare, it's housing, it's jobs, it's safety in your home, and it's opportunity. And underlying all that, the foundation of it is affordability. If people can afford their lives, they will become rededicated to the American dream and to the civic thing that is America, and that is the most important thing we can ask them to do.
All right, Oliver Libby is the author of Strong Floor, No Ceiling, ahead of a big speech by the President of the United States later tonight, and, of course, the response by the opposition party as to what they might actually do on the affordability issue. All right, when we come back after the break, we turn back to markets and we turn back to, well, the biggest company in the world and the biggest earnings report so far of the season, NVIDIA. This is Bloomberg. All right, well, we're less than 24 hours away from the main event of this earnings season. The largest company in the world by market cap, NVIDIA, set to report results. The chip maker's earnings maybe could provide a little bit more insight into reassurance that AI spending remains intact. This is rival AMD actually just announced a blockbuster deal with Meta in a bid to actually catch up with Jensen Huang and company. Doug Clinton joins us right now, CEO and founder over at Intelligent Alpha. And actually, great to have you here, too, because if anybody knows anything about AI and large language models, it would be you. Talk to us about kind of whether expectations are actually maybe a little bit too high going into this. This is a company that's had some blockbuster prints the last couple of quarters, but the response by investors seemed to be a bit more muted.
Romain, I think it's fair to say that the setup is pretty strong going into earnings for NVIDIA, and that probably is the danger. You know, we just had an incredible earnings from the hyperscalers in terms of their CapEx guidance, in some cases getting CapEx raised from expectations, almost 50% from Google and Amazon. So huge demand that they're seeing that obviously translates well over to NVIDIA. I think the danger for the setup is just, it feels like everybody sort of knows that at this point. And so I think you own the stock going into the print, but just be aware, right, that the bar is pretty high. We've already seen these great prints. I think what you really have to hope for if you want that really big upside case just for earnings is to see some kind of flow through maybe from China. That could be the wild card here above and beyond what we're already seeing from demand from the hyperscalers.
Well, that's what I am curious about. And we should just point out for our viewers, we're still talking about a company that is expected, if analysts are right, 68% revenue growth, which is for a company of this size just phenomenal, roughly about $65-66 billion in revenue. But longer term, I'm curious about the China question, because this does not seem to be a function of demand. It's a function of regulation or export restrictions by the U.S. Do you have any insight as to whether Jensen Huang is going to be able to sway this administration to allow it to kind of just unleash its products to China?
it feels like we've sort of been on the verge of getting that sort of unleashing moment for months now, and it just hasn't fully unleashed. And then obviously we have questions on the other side as well. You know, China has sort of been vocal that they may not even allow some of their companies to buy these chips. I think if you just actually separate the politics, though, Romain, set all that aside, if you actually pay attention to something Anthropic said yesterday, they put out a report talking about the Chinese open source model builders doing what's called distillation of their models, which is basically, it's like having someone go to the model and ask it a bunch of questions, and then you take that and you train your open source model. It's kind of like cheating. And so Anthropic said these companies are doing this, but to do that, they really do need to have some access to some advanced silicon. And so the fact of the matter is some of these chips probably are still finding their way into China somehow, and it might be flowing through in some of the demand picture we see no matter what happens politically.
This also gets to the idea of potential competition, real competition for NVIDIA, at least with regards to those high-end chips. I mean, do you think that we could see an AMD or a Google or one of these companies actually become a formidable competitor in this space?
I think the odds are still low. Part of that is just because the install base with NVIDIA, their pace of innovation, and then their ability to reinvest back into R&D is really hard to catch up. I mean, this is kind of a crazy stat. If you look at the free cash flow metrics for 2026 for the Mag 6 companies, basically NVIDIA is sucking up all the free cash flow that Google, Amazon, Microsoft, and Meta used to generate. If you look at the numbers, it's just NVIDIA and Apple that are generating significant free cash flow. But that's a great position for them to be in because they can reinvest in creating those new chips. I think that's what makes it really hard for an AMD, even though they had a great deal with Meta come out today, really hard for them to compete. And Google, they're really doing something a little bit different. I'd say it's a little more adjacent than directly competitive with NVIDIA. So it's hard to see something really hurting them in the next, call it 2 to 3 years.
All right, Doug, always appreciate it. Doug Clinton, CEO, founder over at Intelligent Alpha. And just a reminder, those earnings are expected to drop after the bell tonight. We will have full coverage right here on The Close. Again, expectations are high, 68% growth in revenue and a continued expansion of margins, 75% on a gross margin basis. But of course, most people are going to be looking to the long term to see what Jensen Huang has to say about how you keep a good juggernaut like this going for additional years. All right, that wraps us up here on The Close, but we want you to stick around. The Balance of Power team is coming up at the top of the hour. They're also going to have a special programming starting at 8 p.m. Washington time of President Trump's State of the Union address. You can catch that right here on Bloomberg TV and Bloomberg Radio, also on your Bloomberg terminal by typing Live Go.